Hi, good evening, everyone. Thank you for joining in. And so we today discuss the 55th edition of DSP Netra. I'm Sahil Kapoor. I head the products team at DSP Mutual Fund. And so we write DSP Netra 5th of every month, and it is uploaded on the web link at dspim.com. You can go to the website and check out the present and all the past editions of DSP Netra, and you can download them and read them. So in this edition, which is the December edition, the last edition for 2025, we've discussed a number of important sections, specifically around India's growth. We also discuss, how growth has panned out because there were a lot of discussions after the last quarter's GDP came out, and we thought it's a very important and opportune time to discuss these numbers from a long-term perspective. We've also discussed ideas around large cap versus mid and small cap. We've also discussed ideas based on the shrinkage in market breadth and how uh, capital availability is becoming easier by the day. And the last section emphasizes on the IT sector. So we are going to discuss all these four aspects. I'll straight away jump into the report, and let me share my screen, and we'll discuss the latest edition of DSP Netra. Uh, So let's start with the most important and first section, which is India's growth dynamics explained. Uh, in this section, we'll first talk about the nominal GDP growth and how it has moved over time. The important aspect about growth is that it comes in two flavors. So everybody, speaking or looking at growth, looks at two types of numbers. First number to look at, of course, is always the real growth. A lot of people talk about the GDP numbers, and when they talk about GDP number, they say that India is growing at 6% or 7% or 8%. They are always talking about the real growth rate. Now, what is real growth rate? Uh, Real growth rate is it will roughly equate to volumes, which means that increase in volume of goods that we are producing. So, for example, let's assume that if a country was only one factory producing writing pens. Let's say it produced 100 pens in 1 year, and in the next year, if it produced 110 pens, the GDP growth will be 10%. The volume would have grown significantly. Here, no price considerations are taking in. Of course, this is a very simplistic way to think about it. Then the second consideration comes in what is called as the nominal growth. What is nominal growth? Nominal growth is when you add the price consideration. What is the change in price? If the pens were, let's say, at 10 rupees in the year one, and in the year two, if they, let's say, become 20 rupees, it will straight away double the GDP, which means that, for example, in the first year, 100 pens were for 10 rupees, they were for 1,000 rupees. In the second year, if you still produce 100 pens but sold them at 20 rupees, the total will be 2,000 rupees. So that is how the jump will occur, but purely price based. So nominal GDP is actually a mix of both volume and price. Whatever function each plays a part shows up in the nominal numbers. So nominal growth is more important from a market standpoint. Why? Because salaries and wages, the sales growth of companies, government taxes, all these numbers move with the nominal growth. They don't move just with the real growth. Of course, nominal growth is a function of how real growth is happening. In economic terms, it is called real growth plus inflation, right? So let's look at how nominal growth has moved over the last many years. As you can see, nominal growth in India was very high in 1980s and 1990s, about 15% or so. Of course, the base was very small, inflation was very high. And then you had one of the biggest bull markets in India, the roaring noughties, right? In 2000 to 2013, our nominal growth rate was 13.2, a tad lower than 1990s, but of course, it was very robust. The reason is that 13% itself is a very strong. But post that, you can see our nominal growth has dipped by 2.6 percentage points. And from 2013 to 25, it is 10.6%. Why have we taken these cuts, 2000 to 2013 and 13 to 25? these cuts are not based on how elections happened in India. While a lot of people might perceive it that way, these cuts are based because in 2013 we had the twin balance sheet problem. And twin balance sheet problem caused a huge amount of change in how India's GDP shapes up. And that is one of the biggest drivers. And as you can see, most numbers in India is pre and prior to that crisis. Uh, COVID again is a very large crisis which occurred, but its long-term impact on the economy was much smaller, shorter. The twin balance sheet problem had a much stronger impact. So if you look at the nominal GDP growth rate, how it has moved, I have written a very important point here. Average nominal GDP growth in 90s was 15%. Then it shifted lower to 13.2. Now it is 10.6 over the last 12, 13 years. But in the last two financial year, it has slipped below 10 and then slipped below 9% also. So in fact, our nominal GDP is now touching numbers where we want our real GDP to be. Now let's look at what constitutes or what moves with nominal growth. So if you look at the underlying uh, various data points which either constitute nominal GDP or they move with nominal GDP. Between FY01 to FY13, all these numbers were moving at a very fast clip. You can see 15% change for, let's say, uh, revenues or BSC 500 companies. Sales growth was 14.7% CAGR for about 13 years. Government tax revenue 15% CAGR. Wage bill growth 15.4% CAGR, right? Think about an economy where wages are growing at 15% CAGR, right? A very strong number, right? 15% CAGR means you are, effectively doubling every 4.5, 5 years. Wage bill growth 15.4%, as I said. Money supply 16.7. Stamp duty nearly 20%. Imports of engineering goods 24%. Look at these same data points in the last 13 years. Most of them are struggling at around 10% or so. In fact, BSE 500 company sales growth is just 7.4%. And this is a stark contrast between where the growth is right now. So when you think about India's growth, only the nominal growth, all these numbers clearly tell you that we are far away from that high or let's say mid double digit growth rates that we were clocking in the previous 13 years. And since the twin balance sheet shock of 2013, these numbers have slowed down considerably. Of course, one reason is that inflation numbers have come down, right? Does that mean that our growth should be lower? Yeah, of course, it is possible that growth will fall because inflation has come down. But then the second question arises, is 10% nominal growth enough? Let's assume that we will argue that, yeah, our inflation, which used to be 7%, is now 5. uh, Although the inflation dynamic, let's say, is lower by 200 basis points, but nominal growth is lower by even more. It is lower by 260 or 300 basis points, right? So is 10% nominal growth enough? And if not, why is it anemic? So when you think about 10% nominal growth rate, the only problem with this number is that if this number continues at this pace, then the demographic dividend that India has um, for the next 15 to 20 years, by the time we start losing that demographic dividend, this 10% growth will not be enough. We will not be able to become a mid-income country and we will continue to be a low-income country if our growth rates do not improve. Therefore, 10% is not enough. But now, why is it soft? So, one reason, there are of course many reasons. We've touched one here, that households, which are very, very important component of India's economy. Why are households important? So I have discussed it earlier also that there are three agents in India's economy or any economy: corporates, households, and the government. In India, only the households or the private citizens are net savers, right? Corporate India and government of India or state governments, they are net borrowers. They do not save. So households are the only ones who are the net savers who generate savings in the economy. So their balance sheet is very, very important. And as you can see here, um, In the strong cycle of FY1 to FY13, private consumption for a fairly long period grew at a very strong clip. The 5-year CAGR went up significantly, right? And household consumption was fairly stable, but it was growing on back of wages. You can see the household loans, consumption loans were actually falling, although the consumption was rising, right? The reason was income was going up. So it's very clear. Rising incomes, falling borrowing, improving consumption, which means that consumption was happening on the back of rising incomes. But look at the same phenomena now. After that, incomes have weakened, growth rates have come down, debt accretion has gone up, consumption has slowed down, which means whatever consumption was happening largely was a reflection of higher debt. And this has probably weakened the household balance sheet a bit, not too much, but a bit. And if income increases, slow down, if the pace of rise in income slows down, then it becomes a big problem, right? And therefore, we think that 10% nominal growth is an outcome of this slowdown. And maybe a prescription is to fix this, but that is beyond the topic of our discussion. And that is the reason why this 10% growth is staring us in the face. And as of now, I don't think that we are doing anything significant to repair this aspect. Now, when you think about the economy, consumption, of course, is a very, very important point. The other important part is Capex, capital expenditure. And this is a DSP Capex tracker. So we thought that let's see, consumption is just middling, not doing exceptionally well. What is Capex doing, right? So we drew what is called the Capex tracker. So we looked at every single important line item which goes into Capex. So government Capex, which is of course a big talking point. If you note very carefully, central government Capex is the only item in the whole catalog which has done better than the previous cycle. And why are we comparing FY1 to FY13 and now? Of course, these are the two phases in which the growth has very, very different. And as you can see, all other segments are growing at a much slower pace. And this pace is slower than even nominal GDP growth rate, which means that, and one important and I think most important data point I want to highlight is the BSC 500 listed universe capex. Look at the number, 26% CAGR for 13 years in the last cycle. It is an unimaginably strong number, right? I don't think many countries in the world would have seen these kind of numbers. Maybe China would have done better only. And look at this number at this point in time, 9%. Still a strong number, but much lower than the desired number, much lower than the previous cycle. And look at all other data points, mid single digits, right? They were in the 20s in the previous cycle, or at least double digits, right? So capex, of course, is also very, very slow. We are not seeing very significant signs. Third is the export. So first was consumption. Second was, of course, capex. Third is exports. So if you want to pinpoint one of the single largest and most important factor which has done well for India, or where India has done exceedingly well compared to the rest of the world or rest of the sectors, is services exports. And India is a clear winner, big market share gains over the last 30, 40 years. And look at the data between FY01 to FY25. In the 25 years, services net exports have grown at 22%. I don't think any country would have seen this kind of growth rate. But when you split it up between these two periods, you can see how growth rate has slowed down from 35% CAGR to just 9% CAGR. And as all of us know that IT and ITES majors are now reporting numbers which are lower than 5%. Including GCC, this number is still at 8 to 9%. But is 8 to 9% enough? We don't think so, right? And this number is again telling you that there is a export slowdown even in services, although it doesn't look like a slowdown because the numbers are still very robust. But are they same as they were in the last cycle? The answer is no. They have slowed down appreciably, and this table directly stares you in the face, right? It tells you that how these numbers have slowed down. and by what magnitude? And can we continue to have this kind of CAGR? It's going to be a tough ask. And if services exports slow down, it will directly hit not only our consumption because IT sector employees and others, net services export oriented sector employees add a huge amount of consumption boost to our country, right? And that could be a problem if these numbers do not improve. As of now, these numbers are slowing, not improving. The other part of the export basket is, of course, goods exports, where we export things, right? And we've drawn a table where we talk about all the exports, all different types of baskets, petroleum products, agriculture, allied products, ores, minerals, as you can see, every single basket. What is notable is that if you look at this table closely, you will find that no basket, none of these categories has seen an improvement in net trade, which means that over the two time frames that we've seen, net export for any of the item has not improved. There is some improvement which is happening in electronic goods, you can see, but from a balance of payment perspective or trade perspective, the number is still very small. It is not meaningfully large to make an impact. And therefore, now think about this, that when we think about the growth drivers, whether it is consumption, middling or slow, uh, Capex, most of the parameters that we are seeing are struggling except government expenditure, which continues to be strong. And third is the export. So services export themselves have slowed down from their glory days to mediocre numbers, and goods exports are very, very mediocre or not even mediocre. I think they have done very poorly. So the net result is that Indian economy currently is stuck in a slow growth phase, although it doesn't appear to be. For example, when you look at the quarterly GDP number coming at 8% plus, you will feel that talking about a slowdown is a joke, right? You will think that how is it possible that if you're growing at 8% and we are talking about a slowdown? It doesn't make sense, right? But the point is that in the same quarter, the nominal GDP growth rate is below 9%. And nominal GDP growth rate matters a lot more for investors because every single aspect of our investment horizon is linked with nominal growth, and that number is much, much slower. Now, if growth is going to be slow, and we'll talk about both stocks and bonds, we'll talk about stocks in just a bit, but if growth is going to be slow, then it's quite possible that uh, the bond market can take a much better clues. So, for example, we put out four charts here, which will be very, very significant in terms of how we perceive bond market. First is that central government isn't borrowing a lot. You can see the fiscal deficit to GDP is number is stuck close to 0%, and because of which the government is not borrowing a lot. Uh, Second is our inflation is running at a multi-decade low. You can see that from 1990 onwards, the numbers have slowed down significantly. Um, Third is the spread between nominal GDP growth rate and 10-year GSEC is very, very narrow, which means our growth rate has slowed down, but interest rates have not fallen. This is not very helpful for the economy, which means that rates should be lower than where they are right now. And rates will be lower. Uh, by rates, I mean yields should be lower. 10-year GSEC yields. RBI has already started cutting rates. They have already cut rates many times, but the bond yields have still not fallen, right? And fourth is that the difference between, as I said, between the policy rate and bond yields are still very high, and because of which we are seeing that there is some room for bond yields to fall, and therefore this is the precise reason why we feel that duration or long bonds is a very good strategy, which means that they might be very helpful for India for investors to focus on. So there is an opportunity in buying duration, 10-year plus maturity. We think that is a good point for investors to align themselves, align their portfolio. Um, we have seen, uh, overall bonds. not doing so well because yields went up from a certain point. Uh, After touching about 620 or so, yields went up, and at 650, it's 660 right now. I think it's a very good entry point where some duration can be added to the portfolio. The second section will talk about stocks. Uh, you can see that larger stocks is a very, very important indicator. And we spoke about this in the last year also, where we spoke about large cap stocks. And since then, Nifty and other bigger indices have done much better than the rest of the market, where we've seen that uh, mid and small caps have either been listless, where they have been sideways, or they've seen some steep corrections. So first chart tells you that the largest stocks are beginning to outperform. So it has two lines. One is the Nifty top 10 equal weight index, which is composed of the top 10 stocks. You can see it has been underperforming for quite a while. It started to outperform last year, then again had a period of dull period, and then again now it has started to move up. You can see its 2-year alpha has also started to improve significantly. What does it tell you? That larger stocks are now doing better than rest of the market. We have compared it to Nifty 500. Now, what does it signify? I've written it here that whenever we see the top 10 starting to outperform after a lull phase, it is generally a risk-off environment where other mid and small caps do not do so well. You can see that I will mark one era which is very, very important, which was earlier called the Ritik era, where, large cap stock did exceedingly well. It was a very strong period for large cap stocks. Maybe we are entering such a period once again where these stocks will do relatively well. And also remember that this is just a relative comparison. It does not tell you that large cap stocks will double, triple, or go up in price significantly. It just means that they will do relatively better, which means that, for example, if let's say mid caps were to fall by X%, let's say 20%, then maybe large caps will fall 10 or lesser, right? So it will become a hiding place. Second is their share in the overall market is also low. You can see that the share of Nifty or the top 10 stock total market capitalization is close to an all-time low, which means that the larger stocks are much lower. And the reason, because the other part of the market has done so well that their market caps have gone significantly higher. So I'll give you one data point. In the last few days, smaller stocks have seen some amount of correction. In fact, stocks with market cap of less than 1,000 crores, uh, almost half of those stocks fell nearly 40% on. That is how brutally these segments move, which are the smallest segments. But large caps don't move so much, right? So when bull market happens, these smaller companies go up significantly, and that is what has happened there. The large cap rates have come down, making them more attractive. Last time when they were at 22%, the top 10 stocks, it created that Ritik era where the rally happened and their weight doubled. Right now, we are even lower than that. The next is again one more signal favoring large caps over mid and small cap. We have shared this earlier also. This is just a reiteration. This is coming from a Flexicap formula, where the Flexicap formula is now indicating a preference for large cap stocks. What does it do? It's a ratio of Nifty mid and small cap 400 divided by Nifty large cap, which is Nifty 100. Whenever this ratio breaches the 200-day average, it shows that the preference moves from mid and small cap to large cap. And recently, it broke the 200-day average. So it tells you that market is now moving in favor of large caps rather than in favor of mid and small cap. And whenever this ratio takes hold or the trend takes hold, as you can see in the past, this trend has been quite brutal. Whenever the trend has continued for, let's say, 6 months or 1 year period, there has been large risk of scenarios where mid and small caps have fallen quite a lot. Large caps also fall, but they fall much lower, right? And usually it is, an indication that the market is going through a correction or even a bear market. That is what we've seen in the past. Third is the market breadth. How is the market moving broadly? So we put out this chart. Of course, we did this at the end of November. Now we are sitting on 8th or 9th December. Some correction has occurred in the last 8 to 9 days. Maybe a small start was made. But what was happening is that very few stocks were making new 52-week high. Although Nifty was at um a new all-time high, NSE 500 was close to an all-time high, but only 3% of NSE 500 stocks were at all-time high. Um, which means that lot of stocks were not moving up or not moving to a lifetime high. Um, which means that the market was driven higher by just a few stocks. And I've written here important insight from Bob Farrell, which says that markets are strongest when they are broad and weakest when they narrow to a handful of blue chip names. This is what Bob Farrell has said. So this is exactly what was happening or is happening, where most stocks are either below 200-day average or not making lifetime high, but market is close to lifetime high. And as you can read here, weak market breadth. This is what is called weak market breadth. What is breadth? The broadness of the rally. It was weak. If it is weak, it is an early sign of caution, right? And this is what we are seeing. Um, uh, the next, of course, is a very important metric where we will marry our nominal GDP discussion that we did a while ago. So the conclusion from the discussion was that the nominal GDP is slow, maybe 10% or so, or maybe even lower. Let's say it is between 9 to 10%. Now it directly goes and sits with the sales growth. Okay. So let's say that if you look at, let's say, BSE 500, half of the revenues are driven by exporters. For example, exporters and globally linked companies. Who are these guys? IT companies, commodity linked companies where prices are derived from global prices, pharmaceuticals, auto ancillary exports, etc. All these drive their top line from either exports or global linked prices, right? We know that those numbers are not growing beyond 10% in INR terms. We know that the growth rates are either 2, 3, 4, 5% plus inflation. And domestically also the growth rates are just about 10%, which means that sales growth is just about 10%. In this chart, you can see actually the numbers which are coming in, the sales growth is just 4% in the most recent quarter. Let's say over the last 6 to 8 quarters, it's been around 6 to 7%. So if sales growth is 7%, and we are saying it can be 10%, let's say it is 10% uh, in line with nominal GDP growth rate and export basket, and margins are at all-time high. You can see this black line, very close to a lifetime high. So margins are very, very good. In corporate India is working as efficiently as possible. Uh, but if sales growth is going to be 10%, how will profits grow at 20%? So which means that if margins are high, let me take you back to the example of the pen factory that we spoke about. So let's say you sell a pen for 10 rupees, right? And now, and let's say your profit margin is 10%. So the actual sales is about 100 rupees, right? So you make 10 rupees as a profit margin. Now, this is the peak margin. Do come what may, you cannot have higher profitability, right? This is for corporate India. Uh, in fact, when I was looking for numbers, uh, US has currently 10.8% PAT margin, which is the highest in the world. We are competing with that country. No other country has PAT margins of 10, 11%. So further improvement is going to be very, very hard. So what will drive the sales of pens or what will drive profitability? Sales growth. We have to sell more, right? But sales are not happening. They are happening between 8 to 10%. So then profit growth of 20% is going to be a big challenge. But why do we need 20% profit growth, right? The problem is that this is what the markets are factoring in. When you look at, let's say, a Nifty mid cap index or a Nifty small cap index or the aggregate numbers, or when you split up the market, you look at all the 500 companies, look at each company and look at its multiple, you will find that most of the stocks are trading as if earnings are going to grow at 20% or more, right? In fact, two-thirds of BSC all cap or 1,000 plus companies have a price to earnings multiple of more than 30 times. which tells you that you need much stronger uh, profit growth. And these numbers clearly tell you that 20% growth is not coming. So what is the outcome? Either the market derates, which means that stock prices fall and valuations become more attractive, or stock prices remain where they are and earnings improve. So either of these two are possible. We don't know which will happen. Both things tell you one thing, that you need to be more cautious in your approach while approaching stocks, specifically mid and small cap, because they are more expensive. The next is, of course, the capital availability. We've seen in any single year when there is a record high for IPO and FPO and fundraising, next year we see large drawdowns. Why does this happen? Because uh, large IPOs and primary market issuance happen when there is a easy money environment, when it is very easy to get funds. And easy money environment is usually followed by tough money environment. Liquidity becomes tight, and that is what the historical precedent says. You can see that whenever we had record highs, for example, 522 billion was FY08 high, we had a very large drawdown in the next year. Similarly, we had FY18, you know what happened in the next year. FY25 itself was a record. And FY26, we are already on. We haven't seen a very large decline yet, but who knows, right? So history says that we generally see large decline, and therefore we have to be cautious. Also, a lot of fundraising which is happening, equity issuance which is coming through the OFS route. And what it has done is that public shareholding has gone up significantly, promoter shareholding has gone down. So this tells you that a lot of promoters are happy offloading their stake and reducing their stake in the market because largely they are getting the deal that they want, which tells you one more time that valuations are not as attractive as they should be. They are very attractive for the seller, not for the buyer. The next is about the MSCI index, and we've seen that India did exceedingly well post-COVID, but MSCI index is now very close to a new lifetime high breakout. It is ready to do breakout of its range of last 17 years. It hasn't done that. Although India is much higher than where it was in 2008, as you know, but the biggest weight in MSCI market is China, which is yet to outperform. And we believe that MSCI emerging market performance will largely be driven by China because it still comes at one of the cheapest multiples available. And now it is also seeing some growth coming back in terms of earnings. So China remains a dark horse among emerging market and probably should do better than um, you know um, rest of the pack. The last section is on IT. We've seen historically IT being a bellwether in terms of performance also. And lot of IT companies feature as one of the best wealth generators in India. But over the last 3 to 4 years, they haven't done exceedingly well. Largely been in a consolidation phase, and last 1.5 years was tough for them. A lot of debate around AI, etc. So because of all this, now they have become under-owned. Currently, the IT sector weight is close to a decade low or even more at 10.2%. You can see that whenever the weight has been this low, 1 year returns have been very high. You can see in the past, they outperformed by a very wide margin. And when the weight was at lifetime high, as you can see, just after COVID, the 1 year performance was dismal. Right? And we've seen this. Currently, they are under-owned. This chart we produced 3 months back. If you remember, we've reproduced it here as a section. Second is that its performance versus Nasdaq is at an all-time low, roughly at minus 48% 3 year rolling basis. It is underperforming Nasdaq by a very wide margin, and rightfully so because Nasdaq has delivered excellent earnings growth while Nifty IT has not. So there is a reason for this underperformance, but this underperformance is now very stark. Second thing is that there is a fundamental difference between the return ratios. Nasdaq has a ROE of about 22%, while Indian IT or Nifty IT has a ROE of about 25.5%. Currently, Nifty IT is much more cheaper than where Nasdaq it is about 22 times trailing versus 38 times trailing. So we think that you have to make a choice. You want to buy an underperformer, under-owned sector, and probably fairly priced, as we show here, uh, PE multiple for most IT companies, at least the largest IT companies, are now priced much more better than what they were earlier. So some large cap companies have become much more cheaper, and we think that uh, underowned, underperforming, and fairly priced bet, which is Indian IT, is probably much better than having global tech exposure, which is overowned and probably overpriced. So with this, I think I covered all the four sections. Uh, One thing is very clear that markets fluctuate, although on social media we always see that it's being said that market always go up. That's not the truth. We'll see fluctuations happening up and down, and we need to be patient with these fluctuations so that we are able to benefit from them. So I will stop here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.